Saving for college with a 529 plan is an incredibly smart financial move, but knowing the specific rules for withdrawals is crucial for protecting your hard-earned savings. Are you sure every expense you pay from it will be penalty-free? Not all college-related purchases are eligible for 529 plan withdrawals. Generally, expenses not directly tied to tuition, mandatory fees, books, supplies, equipment, or room and board for at least half-time students are considered non-qualified. This also includes costs not associated with special needs services or expenses for enrollment at an eligible educational institution. The Internal Revenue Service, or IRS, meticulously defines what constitutes a qualified education expense for 529 plans. If you withdraw money for non-qualified expenses, the earnings portion of that withdrawal will be subject to federal income tax and typically an additional 10% penalty. This framework ensures that the significant tax benefits of a 529 plan are exclusively used for educational purposes as outlined by law, rather than for general living expenses or personal purchases. Understanding these specific IRS guidelines is absolutely key to maximizing your savings and skillfully avoiding unexpected financial costs. To confidently ensure your withdrawals are eligible, always keep detailed records of all educational expenses, meticulously including receipts for tuition, housing, and books. Consistently double-check that your student is enrolled at least half-time for room and board expenses to qualify, and remember that housing costs cannot exceed the allowance determined by the school or, if living off campus, the actual housing cost. If an expense feels like it might be a gray area, diligently research the IRS publication 970 or consult with a qualified financial advisor to confirm its eligibility before making any withdrawals. Being proactive in this area is much better than facing a tax penalty later on. Some common expenses often mistakenly assumed to be qualified include student loan principal payments, transportation costs like gas or plane tickets, health insurance premiums, or fees for non-credit courses. While student loan interest up to a certain amount can be a qualified expense, repaying the loan principal is not. Similarly, the cost of a personal computer is only qualified if it is required for enrollment or attendance. Knowing these often overlooked distinctions can make a huge difference, allowing you to strategically manage your funds and ensure every dollar you withdraw truly supports your educational goals. By taking the time to understand these IRS rules, you can confidently navigate your 529 plan withdrawals, ensuring every dollar withdrawn goes toward qualified education expenses. This careful planning helps you avoid unnecessary taxes and penalties, ultimately preserving more of your savings for what matters most, funding a brighter educational future.